Welcome to the deep dive. Today, we're tackling, well, quite a bit. We've got sources covering two really huge, interconnected global forces.
Yeah, massive. On one hand, you have the nuts and bolts, the physical infrastructure of our digital world, think undersea cables.
And on the other, high-stakes European geopolitics, Russia, NATO, sanctions, the whole nine yards.
It's a lot to sift through, definitely.
Yeah.
We've gone through everything from the economics of these giant cable-laying ships to, believe it or not, Russian fighter jet flight paths.
Wow.
So our goal for you today is really to cut through that daily market chatter, find the big structural long-term investment shifts hidden in these global trends.
Okay, let's unpack this. Let's start under the sea, actually. Submarine power cables. I mean, most people probably never think about them.
Right, invisible arteries, really.
But suddenly, the market for putting these things in and fixing them is, well, apparently one of the hottest markets globally. Why? What's
Right.
driving this huge, sustained boom all of a sudden?
Well, initially, the growth was really about clean energy. Connecting those huge offshore wind farms back to the grid on land. That was the first wave.
Makes sense. Green energy needs pathways.
Exactly. But our sources are pretty clear. The real explosion in demand right now, it's being driven by artificial intelligence, AI.
Ah, okay. AI needs tons of processing power, right? Which means just enormous amounts of electricity.
Precisely. We've started calling these AI data centers electric hippos. It's a good visual, I think,
Huh. Electric hippos. I like it. Why hippos?
because they need massive, stable, and cheap power constantly. 2047, they are incredibly hungry, and they absolutely cannot afford any downtime. Zero.
Okay, so that intense need, that hunger, it must be changing how companies get their power.
It really has.
Yeah.
Fundamentally, it's led to this big surge in something called direct power purchase agreements, PPAs.
PPA, so like big tech companies signing deals directly.
Yeah, exactly. They're bypassing the usual utility companies and contracting straight with offshore wind farms. They're desperate to lock in that stable green power supply for years to come.
So there's a new formula emerging here. Offshore wind generates the green power.
Uh-huh.
The submarine cable carries it.
Right.
And the AI data center, the electric hippo, just consumes it.
That's the chain. And that linkage, it ties the whole energy transition directly to the digital transition. It's a powerful combination.
Which guarantees long-term growth, presumably.
Yeah.
Because both those trends are massive and ongoing.
Absolutely. And what's really interesting is the synergy this creates for the companies doing the work. Think about it. Data centers need power cables, obviously,
Yeah.
but they also need communication cables, fiber optics for all that data.
Ah, of course. Both power and data flowing along similar routes.
Exactly. So companies like LS Marine Solution, they're now in a position to install and maintain both power and data cables, often for the same tech client at the same time. It really amplifies their value.
Okay, so the demand side is just screaming. Huge demand from energy, huge demand from AI. But markets aren't just about demand, are they? What about supply? What are the sources telling us about constraints, this great bottleneck idea?
Ah, yes, the bottleneck.
Mm.
That scarcity is really the core reason this looked like an investment supercycle, not just a temporary blip.
Okay.
It's driven by three critical shortages, and these have really high barriers to entry. You can't just flip a switch and fix them.
All right, let's break them down. What's the first big shortage?
First up, manufacturing capacity. There are only a handful of major global manufacturers that can make these highly specialized, high-voltage submarine cables. Companies like LS Cable, Taihan Electric Wire, Prysmian in Europe.
And they're busy.
Oh, incredibly busy. Their order books are full. We're talking backlogs of 3, 4, even 5 years already.
Wow. 5 years.
And you can't just build new factories overnight. These are massive, complex facilities. It takes maybe 2, 3 years just to build and get one certified. So that shortage, it's baked in for years, probably the rest of the decade.
And I assume the tech involved isn't simple either. It's not like making extension cords.
Not at all. It's highly specialized engineering, which leads to the second bottleneck, installation vessels.
The ships that actually lay the cable on the seabed.
Exactly. These cable-laying vessels, or CLVs, they're extremely rare. These aren't just regular construction ships. They need dynamic positioning to hold steady in rough seas, specialized gear to handle these incredibly heavy yet delicate cables. It's very niche.
And I bet renting one costs a fortune.
Exorbitant day rates, yes. And here's the kicker. The existing fleet is aging. Our sources suggest nearly half, almost 47%, of the current CLVs will need replacing by 2040.
So the shortage could actually get
It
worse.
looks that way, which just drives those vessel prices even higher. It really concentrates the power with the few companies that own these ships.
Okay, manufacturing capacity, specialized ships. What's the third piece of this scarcity puzzle?
The third bottleneck is skilled labor, people. Specifically, the highly trained engineers you need to connect and install these high-voltage direct current, or HVDC, cables.
Right. It's not just laying the cable, it's making the connections work safely, underwater often.
Precisely. It's complex, high-voltage work. You need certified experts, and you can't just train them in a few weeks. It takes time to build that expertise.
So these three things together, manufacturing limits, vessel scarcity, skilled labor shortage.
They create what the sources are calling a super sellers market. In Korean business terms, they use super ul, meaning the supplier has immense power.
Okay, so the sellers, the cable makers, the installers, they have the leverage.
They have tremendous pricing power, and that means high profit margins are likely sustainable for a long, long time.
Okay, here's where it gets really interesting. This whole setup, this bottleneck dynamic, it screams a classic investment idea, doesn't it? The old gold rush analogy.
That's exactly the parallel the sources draw. The lesson from the gold rush is simple, right? Don't bet everything on finding the one lucky miner who strikes the biggest gold vein.
Because most miners fail.
Exactly. Don't try to guess which specific AI company or which single offshore wind project will be the ultimate winner 10 years from now. It's incredibly hard to predict.
Instead, you invest in the things they all need, the essential picks and shovels.
Precisely. And in this context, submarine cables are the picks and shovels. They are fundamental for both the energy transition and the digital transition. Everyone needs them.
Okay, so that makes them a kind of foundational investment opportunity then across the whole supply chain.
Absolutely. You look at the manufacturers like LS Cable, Taihan Electric Wire, you look at their huge order backlogs, its visibility.
Right.
Then you look at the installers and maintenance crews like LS Marine Solution, where their value comes from that scarcity of ships and skilled labor we talked about.
And maybe even suppliers further down the chain, materials, components.
Potentially, yes. The opportunity runs deep. And look, this isn't just theory. We're seeing it play out right now. LS Cable is building a huge new HVDC cable factory over in the UK, the Tyne factory, specifically for this demand.
Ah, concrete evidence.
And Taihan Electric Wire just landed a big long-term deal with the UK's national grid. So the investment is happening. The contracts are being signed. It's real.
Okay, that focus on critical infrastructure, the picks and shovels, it actually leads us pretty smoothly into our second major theme today, geopolitics. Because the demand for these vital cables isn't the only big story changing the investment landscape, as Europe is rewiring itself for energy and data. It's also dealing with some pretty intense geopolitical risk, isn't it? Let's shift gears from the seabed to the tensions simmering on Europe's eastern edge.
Yeah, it's a significant shift. The sources indicate the tension between Russia and NATO. Well, it's moved beyond just isolated incidents. We're talking about a phase of more direct tension now.
Direct tension, what does that look like? The sources mentioned some specific events in September 2025.
They did. The provocations were described as escalating, continuous, and unprecedentedly brazen. That's quite a strong description.
Brazen how? What specifically happened?
Well, most seriously, Russian MiG-31 fighter jets apparently flew 10 kilometers inside Estonian airspace. That's NATO territory. A serious probe of defenses.
10 kilometers deep. Wow, that's not accidental.
Highly unlikely. And that came just days after drone incursions into Polish airspace, too. So it suggests a pattern, a systemic pressure being applied right across that eastern flank.
And we need to remember this isn't just about jets and drones, is it? There's this whole other layer, what experts call hybrid warfare.
Absolutely. It's crucial to understand. While you have the military posturing, Russia is simultaneously working to undermine Europe's political stability, targeting the soft underbelly, as one source put it.
How? What are the tactics?
Election interference is a major one. Those sources point specifically to the upcoming Moldovan election scheduled for September 28th.
Moldova. Okay, caught between Russia and the EU. What's happening there?
Russia is reportedly running operations with names like Matryoshka and Overload. These involve flooding the country with disinformation, trying to stir up violence, and directly manipulating voters.
So, trying to derail Moldova's move towards the West.
That seems to be the goal, yeah. Destabilize the country before it can get closer to the EU. It just confirms this conflict is being fought on multiple fronts: military, political, economic, informational.
Okay, so faced with this rising military pressure and these hybrid attacks, How did the EU push back? They hit Russia's wallet, right, with
Mhm.
their 19th sanctions package.
That was the big counterpunch, yes. A very decisive economic move. The absolute core proposal in that package was a formal, complete ban on importing Russian LNG, liquefied natural gas.
LNG, wasn't that pretty much the last major energy lifeline Russia had into Europe after the pipeline gas got cut way back?
It essentially was, yeah, a huge source of cash flow. And banning it isn't just economic, it's symbolic, too.
How so?
It moves up the timeline. The EU had a target to end all reliance on Russian fossil fuels by the end of 2027. This ban effectively pulls that deadline forward to January 1st, 2027.
Sending a clear signal.
A very firm resolve, as the sources described it. They want to cut off the funding completely. And this LNG ban comes alongside other measures, like cracking down on Russia's shadow tanker fleet, those ships they use to get around existing oil sanctions.
Okay, so we've got military tensions ratcheting up and economic warfare escalating. This has to be impacting markets. The big question for you, the listener, is what does this new normal of higher tension actually mean for your investments?
Right. Well, first, you absolutely have to factor in the geopolitical risk premium. It's not background noise anymore.
Meaning the possibility of things getting worse in Europe is now just built into asset prices.
Exactly. Any investment heavily tied to Eastern Europe, their currencies, their bonds, their stocks, is going to see more volatility, more ups and downs. You have to treat this risk as a permanent feature now, not some temporary thing that will just blow over.
Okay, so more risk, more volatility. But that usually creates winners and losers too, right? Especially in energy, with Russia being squeezed out.
Oh, definitely. Clear winners and losers emerging. The most obvious beneficiaries of this Russian LNG ban, U.S. LNG exporters.
Because they can fill the gap.
They're best positioned, geographically and in terms of capacity, to scale up quickly and replace those Russian volumes Europe won't be buying anymore. Qatar is another winner, potentially.
And the infrastructure needed. Ships, terminals.
Yes, related energy infrastructure companies stand to benefit too. The owners of LNG carriers, the operators of import terminals in Europe, they're likely looking at some long-term tailwinds.
Okay, those are the winners. What about the losers? Besides Russia, obviously.
Well, within Europe itself, energy-intensive industries are facing real pressure. Think chemicals, fertilizers, sectors that relied heavily on that relatively cheaper Russian gas for years.
They were already struggling with high energy prices, weren't they?
They were. And now, losing access to that Russian supply source means they face significant structural cost increases. It can make them less competitive compared to rivals in, say, North America or Asia who have access to cheaper energy. A tough spot.
But there's one sector that probably sees structural growth from all this tension, right? Defense.
Absolutely. That's almost guaranteed. NATO defense spending is accelerating right across the alliance. Everybody's opening their wallets.
Is the spending focused anywhere in particular?
Yes, the focus seems quite specific. It's on defensive systems, things like air defense to counter those MiG flights we talked about, surveillance assets.
Stuff to protect territory.
Exactly. And also, crucially, cybersecurity. Beefing up defenses against the kind of hybrid warfare, the election meddling, disinformation campaigns we see aimed at places like Moldova. That's a big growth area too.
Yeah.
Hashtag tag outro. So if we boil down this whole deep dive, we've really got two powerful, distinct macro themes shaping things. First, that submarine cable market. It's being driven by this almost inevitable structural demand from AI and the energy shift. That points to a long-term supercycle, pretty much regardless of day-to-day economic bumps.
Right, the picks and shovels play. Very structural.
Yeah. And second, you've got European markets. They're now just permanently shaped by geopolitical risk. It's not going away. You have to treat that as the new normal in any investment thinking for the region.
So whether you're looking for that perceived safety and essential infrastructure, the picks and shovels, or you're trying to navigate the swings in energy markets being redrawn by sanctions, both stories really demand a long-term view.
Strategic thinking. Focusing on companies that have some kind of durable advantage, maybe unique tech, maybe that scarce production capacity, or maybe just being in the right place geopolitically.
And thinking about those cables again, this huge reliance we now have on them for both power and data, it makes them incredibly important strategic assets, doesn't it? National security level stuff.
Absolutely critical. And, there have been reports recently, incidents involving physical damage to cables in places like the Baltic Sea.
Right, those were concerning. Sabotage fears.
Exactly. Which leads to a final thought, maybe something for you to consider. Given how vital these underwater lines are, how long before we see a new investment cycle focused purely on protecting them? physically hardening this infrastructure.
Ah, interesting. So physically securing the cables becomes the next big thing, linking the defense theme and the infrastructure theme even tighter.
It's a definite possibility to watch, a
Yes.
convergence of those two big trends we talked about today.
Food for thought indeed. Okay, that's all the time we have for this deep dive. We'll catch you next time.